Okay, so this mock exercise, again, focuses on accounting for nonprofit organization. And this question is a question called Protect Purple Plants. So the question reads, you have been recruited to act as a treasurer on the board of directors of an NPO that has had difficulty in recent years controlling its expenditures. The board of directors has very limited accounting experience. The organization Protect Purple Plants, so PPP, is considering implementing an encumbrance system, accounting system to assist in the expenditure control. So we saw the purpose of the encumbrance system, right, in the previous video. The PPP receives an estimated of $800,000 per year in regular contributions from the federal government. The first requirement says, what are, or state the two advantages and two disadvantages of implementing an encumbrance system. So that's the first part of the question. So in terms of the advantages, we saw earlier that it allows us to enhance control over expenditure, right? So we know that we have committed X amount of dollars, and we want to make sure that the actual invoices come in and we compare that against the committed to investigate any variance analysis. And again, we're looking at enhanced expenditures over control, so we're going to compare actuals to commitments made and investigate variances. And the second advantage is allows us to track commitments for two reasons. One is we don't want to overspend the amount allocated, okay, in the budgets. And the other part of it is that it allows us to provide note disclosure information. So part of the accounting information that we need to provide our stakeholders at the end of the year is to show how much of commitments do we have or we have made in the current year. That's part of the required note disclosure. The disadvantages, well, for one thing, as you can see, it requires greater accounting expertise. It's time consuming. And remember, we're recording commitments or executory contracts. And it's not GAAP, right? Because we don't record that normally until the actual transactions occur. So there's a couple of reasons why there are advantages and disadvantages, but quite frankly, if you have an organization that basically is accountable to how they spent the money, and you've got multiple different people buying stuff for the organization, and it's a way for perhaps the accounting executive to track how much money has been spent, how much money has been committed. And so it's really important, again, to decide whether the benefit outweighs the cost. And if you ever go through organizations like hospitals that have, bigger hospitals have about 5,000 to 10,000 employees, and some of those employees are actually purchasing for their own departments, then it's probably imperative that you might want to have an encumbrance system so that you can track how monies are being spent. Okay, so imagine the receiving department will receive a whole bunch of goods and they don't know exactly what was the commitment and whether they should be accepting those goods as well. So that's part of the reason why hospitals will often do an encumbrance system. Now, Part B says PPP uses the deferral method. So that's important to note. For accounting for contributions, and it has no separate fund for restricted contribution. On January 1st, year 6, PPP received its first restricted cash contribution of $100,000 to purchase and maintain of land, maintenance of land in a greenhouse building for its purple plant collection. So first, we need to record that entry. So January 1st, year 6, we're going to debit cash because we receive cash. And we're going to credit deferred contribution because we haven't spent it yet, or deferred revenue. So let's call it deferred revenue for short. Now, on July 1st, year 6, they acquired land and building for $22,000 and $60,000 cash. So we need to record that. Debit land, credit building, credit cash. The building has estimated useful life of 20 years, so it's good to know, 20 years. No residual value. And on December 31st, year 6, so that would be at the end of this fiscal period, the remaining $18,000 was paid to KI Maintenance Limited for a 3-year maintenance contract that requires KI personnel to provide maintenance service for 4 days per month until December year 9. Assuming the encumbrance system was not implemented until year 7, prepare the journal entries. Okay, so first of all, we're going to debit land. So we debited the land, debit, credit, that's a debit to building, and credit to cash. Now, it says that the remaining $18,000 was paid to, okay, so first of all, let's amortize the building. So on December 31st, we need to amortize the building. So debit amortization expense. And that would be 60,000 divided by how many years? It's 20 years. Now, remember, we bought it on July, so for it's only for 6 months, right? For 6 over 12 gives me 1,500. So debit 1,500, credit accumulative amortization. Now, we're also going to record the prepaid, we're going to record the amortization of that deferred revenue, right? So we're going to debit deferred revenue, and that would be equal to the same amount that we're amortizing, so credit contribution revenue. Now, we're told that the $18,000 was paid for the maintenance, so we need to debit prepaid maintenance, $18,000, and we're going to credit cash. And this prepaid maintenance is a 3-year maintenance that's going to start next year. So it's going to start next year. So that's why the entry is just a debit to prepaid maintenance and credit to cash. Now, I'm going to come back to this it says on July 1st, year 6, the acquired land and building for $22,000 and $60,000 respectively. The building had an estimated life and 0. Okay, on December 31st, year 6, the remaining $18,000 was paid to KJ Maintenance for 3-year maintenance. Okay, so I've got that all accounted for. Let me just see. Okay, now remember the contribution that we received is $100,000, and that original contribution, it says, was to actually, the purpose of that $100,000 is to purchase and maintain land. The fact that we bought land already, we need to debit deferred contribution of $22,000, and we're going to credit the net asset. And that credit to net asset is in capital of 22. So that was the only thing that I was missing from this transaction. So if you think about it, the purpose of this $100,000 is to buy and maintain, That was the thing that you've got to remember, is they purchased and maintained the land and greenhouse building for the PPP organization. The fact that on July 1st they bought the land, okay, means that we need to take part of that deferred contribution and recognize it. But because this contribution is, they call it an endowment fund, right? This is an endowment contribution, which means that they can only be specifically used for a purpose. That's why the credit is the $22,000 is credited against the net asset. So if I go back to my deferred contribution, you'll see that that $100,000 was part of it was an endowment contribution. The fact that we bought that land means that we need to credit the net asset for capital asset, and that's where that section is referred to. Okay, so that's the answer. Thank you.